Just to get to some of the news of the day that we've been talking about all the time, this big bank merger, BB&T and SunTrust. Obviously, regional banks, not the same thing as brokerage firms and investment firms, but you've participated in consolidation. There's been some questions as to whether this is going to be another wave for regulatory or other reasons. How are you thinking right now about consolidation for your business?
Well, as you know, we participated very recently, and in fact, it was a couple of days. Scottrade was a great opportunity for us to help consolidate the industry. My view is that there's a stabilization for a period of time. As you know, there's been always rumors and talks, but we're very focused on just growing organically. I think the bank deal, as an ex-banker, is an interesting one because it does show that the environment is more conducive to allowing these deals to happen, 10 years after the crisis. So who knows if that's the start of an additional wave, but I think we're set for a while in our industry.
You are. So you think this is one of the stabilization periods?
I think so,
yeah. Markets have had kind of a wild run. Obviously, bad December, almost a V recovery in January. Wondering what your read is on kind of your investor engagement, your clients, whether from the trading side, self-directed, or from investment advisory side, because there has been some indication that coming into this year, there was still a reserve of caution out there. Risk appetites may not have been back.
Yeah, so certainly October, November of our last quarter was interesting. December, of course, was the phenomenon you talked about. January, V is a good description from our point of view. Also normal in terms of a rebound back, as you know. So what we saw, my view, is that there are two distinct types of our clients. There are the clients that we're serving here, our RIA clients, and their end clients who tend to be served by the RIA population are really long-term focused, and so this is a bit of an aberration. They have questions, and so they're calling their advisor, and our advisors are spending a lot of time with their clients doing some hand-holding and explanation. When you look at our retail clients that are more self-directed themselves, we call them empowered, they actually like to take advantage of those types of opportunities. December did feel a little different, I would say. There was, if you look at our investor movement index, it actually dipped down. Our cash levels bounced back up, our margin levels dropped, and then that's now slowly recovering as those more active investors get back into the market, and we have that recovered.
Some of the other fundamental inputs for your business, obviously the entire world has downgraded expectations for what the Fed might do for rate hikes this year. Then that comes at a time when you have competitors out there that are running ads about how much they're paying on cash balances and brokerage accounts. So obviously there's some pressure in there. How's that shake out for you?
Yeah, we have a very different view, just as most in our industry do, about what that cash is for and what clients think of it. They don't actually think of that as an investment vehicle, an asset class in and of itself. When it comes to your self-directed account, you're really saying, that's my money that's there as a holding tank until I decide to make that trade. And so as a result, that money is highly sticky. It doesn't usually chase for yield. Some of it does, of course, there's some price sensitivity. And so as a result, it's a very careful balance for us to manage the interest paid levels with the demand sensitivity for clients. We think we find the right balance and make sure that they have got lots of vehicles they can invest in if they do want to search for yield.
One of the areas of investments that has not seen as much fee pressure, some have argued, is the investment advisor channel, right? I mean, you've had mutual fund fees collapse, brokerage commissions collapse. Do you think that's next, or is being closer to the customer protection against that?
It's certainly a help. Let's face it, there isn't anything in wealth management, I think, that isn't under some level of pressure. The question is the rate. And so when I talk to our advisors here, our advice to them as we help them build their practice up is to spend a lot of time thinking about the value adds that they have. If they were still in the asset class allocation business that they might have been 20 years ago, that's been commoditized quite hugely, of course. What they're moving to is more upstream services, the estate planning, the helping you with thinking through how you're going to be okay, and your clients still hugely value that, and they're willing to pay for that.
The emotional support.
Absolutely right.